I'm sure that all of you are pretty aware that February was a pretty rough month for North American stock markets. So the question on most people's minds, I'm sure, is there more pain to come? Well, I've got some technical indicators that suggest that there may indeed be more volatility for North American stock market indices. Today, I'll present those tools and give you an argument for remaining cautious on North American markets. My name is Keith Richards. I'm President and Chief Portfolio Manager at Value Trend Wealth Management, and I'm a technical analyst. And this is the Smart Money, Dumb Money Show. Let's get started. We're going to start off with the S&P 500, and I'll just start off with looking at the basic trend. So let's take a look at this chart, and what I want you to notice is that the S&P has been in an uptrend since the bottom of the 2022 bear market. It has been making higher highs and higher lows. Now recently, if we zoom in a little bit, you'll note that it's moved into a bit of a sideways consolidation. But the main thing we need to understand is that so long as the market is making higher highs and higher lows, it is above this line here, which is the 200-day or 40-week moving average, we're still in a bull market. So all of the comments today that I have to do with the potential for near-term volatility. And remember, so long as we stay in a bull market and if we see volatility, that means that by holding a bit of cash, we can use this volatility to buy stocks at cheaper prices than they were before. So what I want you to look at now are some of the momentum indicators that I discussed in my technical analysis basics video on momentum and breadth indicators. I won't get into how they work today because you can watch that video to have a better understanding of them, but I do want to exercise the principle of divergence of momentum, which was discussed on that video. So what we're looking at here are three indicators. One is money flow momentum, that is the velocity of money flow moving into or out of the market. We're looking at MACD, moving average convergence divergence, which is a long-term momentum indicator, and the RSI, which is more of a medium-term momentum indicator. This is a weekly chart of the S&P 500, and what you can see, as I've drawn for you on the chart already, is that money flow momentum has been definitely declining. That means money is definitely not moving into the market, in fact, may even be moving out of the market at a greater pace than it was before. This is a bearish sign because it's moving down while the market was making higher highs. Same with the MACD. Now the MACD went kind of sideways while the market was making those higher highs. And finally, RSI, which is more of a medium-term indicator, was also reaching peaks the middle of 24 and has moved down to the middle of its line again while we saw markets making new highs. So I'm concerned with this because past instances of these indicators diverging negatively has led into bearish markets. Let's take a look. MACD in particular, we can look at the year 2021. It started to diverge. Oops, I didn't draw that very well, but you'll have to forgive my lousy handmanship. But you can see that was a negative move while the market, up to that point, was making higher highs. We also saw RSI begin to fail just ahead of the peak in 22. And finally, we also saw MFI, money flow, was diverging negatively well ahead of the peak in 2022. This is important because that's what's happening right now. Does this absolutely guarantee that markets are going to fall? No, it doesn't, because there have been times in the past where these indicators can diverge negatively and nothing happens. But more often than not, it is a negative sign. Now let's look at the TSX. TSX is the Canadian 300 stock index, and you'll see something along the similar lines, although in 23 and much of 22, the market was moving sideways for the TSX, and it really only broke out in 24. And by the way, I was one of the early technical analysts that was suggesting the TSX would begin an upward trajectory. And I still like the TSX quite a bit. However, it too moved into a sideways consolidation. It is above its 200-day moving average or its 40-week moving average, as you can see here. However, we have the same problem that the S&P 500 has, which is negative divergence on money flow, negative divergence on MACD, and negative divergence on RSI. Again, this kind of stuff, if we draw a line at 2022, was a leading indicator for market sell-offs going through 2022. When we started seeing these indicators diverge negatively in 2021, it was a negative sign. Now, a couple of other factors I want you to look at. We'll just look at these quickly, but multiple.com has a series of fundamental indicators that you can look at for free on the internet, and I highly recommend you take a look at them every once in a while. You can look at things like the cyclically adjusted PE ratio, also known as the Shiller index, and the regular trailing PE. I'm using the trailing PE ratio for the S&P 500 right now, and you can see I've drawn a red line, and that's at around 25. I have found that if the markets get too much above 25 times earnings on the S&P 500, you're setting up for possible correction. In fact, that's what happened leading into the 2001 crash, leading into the 2008 crash, and leading into the COVID crash. Now, in each one of those instances, by the way, before you say it, you'll see that there was a reason why the markets fell. But remember, if the market is set up, in other words, the balloon is too much inflated, then all it needs is that right sharp object to come along to pop it. And it doesn't matter whether it was COVID or the tech bubble crash or the subprime mortgages. Market was already ready to pop. It was just looking for that one instance that would give it the reason to pop. So we're not quite there yet. We are at 29, so we're in the danger zone, but often these PE ratios can get well into the 35 area or so before you see an actual bear market. However, I just want you to understand at 29, the market is not cheap. Now let's look at the individual sectors, and we're going to look at now forward earnings. So this is what the analysts on the street are projecting. Now I usually like to use trailing PE because those are accurate. We actually know what the earnings were and we know what the price of the market was. Forward earnings are just projections. They're estimations, and that doesn't mean the analysts are right. In fact, a lot of analysts are often wrong with forward projections. So take that for what it is, but the current forward PE based on forward earnings by analysts, and this would be a projection by probably 10 to 15 analysts on the US market, is 21.9. This is for the S&P 500. That's expensive because the long-term average, as you can see, is around 16. Well, if you look down the line, almost every single sector is ahead of its PE ratio on average, with the exception of just a few, okay? I highlight energy, which is a favorite of mine, which is pretty much in line with its long-term PE of around 6.2. It's currently trading at around 6.8. Another one that's pretty in line I didn't highlight is healthcare, 17.7 versus 17.4. And finally, real estate, which really means REITs, that kind of thing, 37, just a little bit under its long-term average. So there are sectors that are cheap, but you can see here that with the exception of maybe those three, most of the sectors are well ahead of its long-term average forward PE ratio. What that means is we can't blame the overvaluation on the market on technology alone. Final thing I want to talk about, which is my barometer meter. Now, barometer is something I have been doing for a very long time. Actually, I should look back, but I think I've been doing it for around 15 years, and I've been reporting it on my blog. If you click on the link below, you will see that I run a monthly blog. You can subscribe to the blog, and you will be able to see once a month my barometer reading. And I've actually tracked this for many, many years, once a month. And you'll see it's been very, very accurate. So the meter puts 10 indicators together, and really what it is a risk versus reward reading. Keep in mind the market always has risk and always has reward potential. So this is not an absolute indicator. What this is giving you the trade-offs. And if you look at the way the meter is structured, this is a very simple diagram. But basically, if we get readings over 5, that means that on average, the reward potential is greater than the risk. The market most of the time tends to stay within the neutral category, which means that all things being equal, the market usually has a slightly bias towards the upside anyways, so it's okay to be in the market if it's neutral. It's very good to get into the market if it's in the bullish category, and that is usually at the bottom of market corrections such as the one at the end of 2022. And we actually got that signal at the end of 22 as we did in 2009 during that crash. So you don't get a lot of the high ratios here, but you get a lot of neutrals. And sometimes you'll get a move into the bearish zone, which is where we are right now. But you'll notice there's really 3 numbers you can hit within the bearish zone. We're sitting at 2 right now. So it's just kind of entry level into the bearish area, meaning that it's not likely we're setting up for a crash. Again, this is a number of indicators. If you want more information on them, you can read my book, Smart Money, Dumb Money, and I talk about each individual indicator, and you can watch the barometer yourself. I tell you how to put it together. It's not rocket science. It's just a bunch of technical indicators, but I put it together, assign points, and it's been very, very accurate in predicting things, including major market crashes. But what we're getting is a score of 2 out of 8, meaning that the market is not neutral. It is more risky than normal, but it's not outright run for the hills, buy canned goods, and live in a bomb shelter kind of conditions. Okay? So I hope that gives you some ideas that the momentum indicators and the barometer and PE ratios are all indicating that things are a little bit perhaps overdone, and maybe we'll get some more volatility. Still, we have the positive seasonals coming after March, and we also have a long-term trend line that's in place. So any volatility that we see over the coming month or so should be taken advantage of. And you can follow my blogs and watch these videos, and I will help you with ideas as markets move. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at Value Trend. And by the way, I don't just talk the talk. I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.